Welcome to the Stock Market Palantir. Today we are going to talk about .coin.
Right. We are looking at Coinbase Global Inc. here in late November of 2025. And this company is just not the simple cyclical crypto exchange it was even a year ago. I mean, it's executed this fundamental pivot. It's now a complex, diversified financial infrastructure provider.
Mm-hmm.
And this evolution, supported by, huge regulatory tailwinds like the spot Solana and XRP ETF approvals, has pushed its valuation multiple to nearly 40 times forward earnings. So the central question really is, does this new everything exchange thesis justify that premium?
Or does that acute 25% drop we just saw in November, which was driven by some really heavy institutional hedging, suggest it's just fundamentally overvalued compared to its peers? I mean, traditional exchanges trade closer to a 25 times multiple. That 40 times multiple it's the red flag for me. It suggests the market is pricing imperfection, and November showed us just how fragile that idea is. I think Coin's valuation is deeply coupled with speculation and, frankly, a lot of external market risk, not the operational stability everyone's talking about.
See, I fundamentally believe that high growth valuation holds up because Coinbase has successfully built an incredibly deep moat in the digital asset space that it demands this kind of premium. Let's just look at the operational reality for a second. The Q3 2025 financial performance, it was robust. Net revenue of $1.9 billion. But the real story, the structural story, is in the subscription and services segment.
Okay.
That stablecoin-driven revenue generated $747 million. That's up 14% quarter over quarter. That figure represents a foundational floor for earnings. It successfully insulates the company from the most brutal swings in, spot crypto volatility. And on top of that, the acquisitions of Deribit, which captures 80% of global crypto derivatives, and Vector for high-speed Solana trading, they confirm they're consolidating the entire financial architecture of this digital economy. They're not just a ramp anymore. They are the compliant gateway to everything, and that justifies a premium well above the, let's be honest, boring 25 times multiple of a traditional exchange.
I see the structural improvements, I do, but I disagree on the scale of that premium. A 40 times forward earnings estimate, which, by the way, Argus Research specifically called out in their recent downgrade, is significantly stretched. It's stretched compared to the 24 to 27 times multiples of established players like NASDAQ or ICE. When a stock trades at nearly twice the valuation of its entrenched competitors, it means risk is being dismissed, not diversified away. And when you peel back the layers and look at the market microstructure, the institutional skepticism it's pronounced. Almost 50% of Coin's trading volume is happening off-exchange in dark pools, and this isn't neutral activity. It signals that sophisticated entities are managing huge positions away from the transparent order book. You couple that with the fact that the short volume ratio frequently goes over 50%, it hit 54.23% in late November, it just confirms the stock is being used as a high beta hedging proxy for the entire volatile crypto economy. It feels like retail enthusiasm is driving the price up, while institutional capital is using Coin to bet against the whole complex.
That's a compelling point about the defensive flows, I'll give you that. But I think you're misinterpreting the long-term meaning of the diversification engine. The shift is structural, regardless of what institutions are doing tactically in the short term. Coinbase is now the designated custodian for all these new spot ETFs, Solana, XRP, probably others to come. That instantly translates major asset flows into high-margin, sticky custodial revenue.
Right.
We're not just talking about trading fees anymore. The $747 million subscription segment is being secured by legislative momentum. You've got the Genius Act, which wants to federally recognize stablecoins. That gives regulatory certainty to their massive USDC revenue stream. This legal and operational certainty, it transforms those high-margin flows from just transient income into something more like annuity revenue, making the valuation way more defensible against these dips.
I'm sorry, but I just don't buy that the subscription revenue floor is truly stable. Not when you look at the source of that profitability. Let's just remember that the bulk of that $747 million is heavily reliant on monetizing the USDC reserves. And that monetization model only works in the current high interest rate environment set by the Fed. We are pricing coin at 40 times based on the continuation of macro factors that are, by their very nature, transient. So what happens if macro conditions force the Fed to start cutting rates, say, because of a softening economy? That reliable interest income floor will rapidly erode. The earnings floor drops, and suddenly the stock is exposed to that exact same brutal volatility that you claim they've diversified away from. So, the diversification isn't complete, it's dependent on a shifting central bank policy.
I would argue that even in a low-rate environment, the custodial revenue stream from the ETFs provides longevity. Even if the absolute income falls a bit, they are still the infrastructure. But, okay, let's address the elephant in the room, that institutional skepticism and the high short volume. You frame the extreme off-exchange short volume, peaking above 54%, and the spikes in fails to deliver, like that 58,000 share spike on October 30th, as evidence of severe strain.
It is absolutely a battleground. And just to be clear for the audience, fails to deliver, or FTDs, that's a signal that sellers have failed to deliver securities by the settlement date. A persistent spike in FTDs alongside a 50+% short ratio suggests institutions are actively betting against the price with large, sometimes difficult-to-settle positions. This is the market telling us the stock is highly risky at this valuation.
That's a compelling argument, and it's rooted in, pretty solid technical signals. But you need to consider the context of who is accumulating during these high-friction moments. When Argus downgraded the stock, what happened? We immediately saw Cathie Wood's ARK Invest execute a highly visible buy-the-dip maneuver, right? They picked up over 62,000 shares in that 250 to 270 range. This signals that innovation-focused funds see that correction as a temporary dislocation from fundamental value.
But one firm's trade.
And furthermore, the high dark pool activity, which you cite as a sign of distribution, can just as easily be characterized as sophisticated institutional accumulation. For a stock this volatile, institutions have to execute large trades away from the public eye to avoid massive price slippage. So the dark pool activity in this context is simply the mechanism for high-conviction players to build their long-term positions discreetly. It's repricing and accumulation, not just distribution.
But is one specific investment firm's tactical trade really indicative of the overall market structure when half the trading is happening hidden from view? I mean, we can't just dismiss a 50+% short ratio as routine market making. It signals that a huge chunk of capital views the current price as structurally unstable. The stock isn't behaving like infrastructure yet. It's behaving like a highly volatile tech stock with extreme speculative exposure. And, speaking of speculation, let's pivot to the regulatory landscape.
Yes, let's. The regulatory environment is the final key to unlocking that 40 times multiple. The anticipated end of SEC Chair Gary Gensler's tenure, plus the momentum of the Clarity Act, which would define digital assets as commodities, is existential for coin. This removes the massive regulatory overhang that has suppressed the multiple for years. The recent ETF approvals just further validate the compliant, centralized gateway that Coinbase has become. We are pricing in political stability here.
I would just caution that the regulatory premium you're arguing for is inherently speculative. It's subject to serious execution risk. You're assuming the legislative outcome is a guarantee. The Clarity Act still has to pass a potentially gridlocked Senate. If there's a stalemate, that regulatory overhang, including all depending litigation, could persist for years, keeping that suppression on the multiple. And moreover, let's look at the operational execution risk of your everything exchange thesis. You cite the acquisitions of Deribit and Vector, but how seamless is that integration, really? Integrating a global derivatives platform and high-speed Solana trading takes massive capital and time. If those expensive acquisitions fail to realize synergy, or if the market shifts away from them, well, those operational missteps will quickly justify the Argus downgrade. That November correction was a classic sell the news event, showing how quickly euphoria can fade if things aren't perfect.
The operational risk is inherent to any growth strategy, sure, but the scale of the prize justifies it. Capturing 80% of crypto derivatives is a structural control point. I believe the diversification is already executed, and the legislative momentum is overwhelming. We are past the point of fundamental regulatory risk. We're just debating the timing now. So to summarize my position, Coinbase's Q3 financials confirm a structural pivot away from spot volume. By consolidating all these crypto infrastructure layers, derivatives, high-speed trading, the USDC economy, the company has fundamentally de-risked its business model. It has graduated from a simple exchange to an integrated financial super app, and that high growth multiple is absolutely justified because its moat is becoming impenetrable.
And I'd summarize by saying that while the business model is significantly improving, the stock price remains a highly volatile, high beta proxy for the entire asset class. It's characterized by extreme institutional hedging, the dark pools, the persistent high short volume, and a valuation approaching 40 times forward earnings that leaves virtually no room for error. The divergence between that aggressive retail optimism and the sophisticated defensive institutional flow is a significant and enduring risk factor that I believe warrants a multiple much closer to established finance.
Ultimately, I think the volatility we saw in late 2025, all of it, the hedging, the valuation friction, is just the natural growing pains of a high-growth company graduating into the mainstream financial system. Investors now have to weigh those stable, annuity-like revenue streams against the remaining legislative uncertainty to decide if that 40 times valuation is merited.
The friction is very real, and until that regulatory certainty is fully delivered, that friction is going to continue to be priced in through volatility.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.